Welcome to Chillin' 101. We hope this video helps.
You start by narrowing the field. Pick 1 to 2 instruments and a consistent time frame. Once chosen, collect a baseline sample of 30 to 100 recent trades or bar data to measure behavior. Make sure to log entry triggers, exits, and position size. This creates objective metrics you will improve. Use those baseline stats to set realistic targets for win rate and risk per trade. This focused start prevents scattershot testing and gives you a clear performance reference to iterate from. Now you turn hypotheses into rules. Write 3 to 6 explicit entry, exit, and risk rules that can be coded or manually executed. Once done, backtest these rules on in-sample data, then validate on out-of-sample periods and walk forward segments to avoid curve fitting. Make sure to track expectancy, Sharpe ratio, percent profitable, and worst drawdown. If metrics degrade in validation, tighten rules or reduce leverage. Repeat with small live fleet paper, trades to confirm behavioral and execution assumptions before scaling. You finalize by scaling cautiously. Increase capital allocation in clear steps while maintaining the same risk per trade and tracking performance against baseline metrics. Once done, establish a monitoring dashboard with alerts for slippage, win rate shifts, and drawdown breaches. Conduct monthly reviews to detect regime changes. If the edge erodes, pause live scaling and return to controlled paper testing to isolate which variable changed, market, execution, or parameter sensitivity. That rollback
Thanks for watching. Consider subscribing if we helped you.